Welcome back to The Deep Dive. We are Talk Tickers, and our mission, well, it's simple. We dive into the sources you shared today. It's an earnings call transcript and pull out the crucial insights. We give you the shortcut, basically, minus the jargon overload.
And today, we're tackling Simon Property Group, SPG. Their Q3 2025 results just dropped. And honestly, this wasn't just another earnings beat. Management really laid out a case for operational strength combined with some really smart high-value acquisitions.
Absolutely. You saw that positive market reaction, right?
Yeah.
And it wasn't just fluff. It was tied directly to these numbers showing, that demand for top-tier retail space is still incredibly resilient.
Yeah.
Let's hit those headline numbers first.
Okay, yeah. The big one everyone watches, Real Estate FFO, that's the non-JAP number, came in at $3.22 per share. The street was looking for about $3.09, so that's a solid 4.2% beat right there.
Nice. That kind of beat usually means things are running smoothly underneath.
Exactly. It signals things are really clicking. And you see it in the revenue, too. Hit $1.6 billion overall. But the core number, the lease income, that grew year over year, jumped to $1.45 billion from $1.34 billion. That's healthy growth.
And the CEO's tone, what was the vibe from management?
Pretty confident. Characterized the quarter as just strong. They pointed to healthy demand across platforms and accelerating shopper traffic. So basically, people are still coming to their properties.
But that confidence showed up in the guidance too, didn't it?
It absolutely did. They bumped up the full year 2025 real estate FFO guidance. The new range is $12.60 to $12.70 per share. That midpoint lift, about 0.115. So that's not just housekeeping. That's a real signal of confidence looking ahead.
Yeah, in this kind of market, raising guidance is a pretty big statement.
For sure. And speaking of returns, good news for shareholders too. They raised the quarterly dividend again, up 4.8% compared to last year, brings it to $2.20, shows cash flow is stable, and they're committed to returning that capital.
Okay, so great headline numbers, strong beat, raised guidance, dividend hike. But like you always say, the numbers have to come from somewhere, right? Let's get into the weeds on the operations. This is where SPG often stands out. Right.
This is the fundamental strength. Let's start with occupancy. Their main portfolio, malls and premium outlets, ended Q3 at 96.4% occupied. That's up 20 basis points from last year. And the Mills portfolio, almost totally full, 99.4%.
Wow, 99.4% is practically unheard of. And with high occupancy, usually comes pricing power.
Exactly. Base minimum rent per square foot climbed to $59.14. That's up 2.5% year over year. So yeah, they're filling space and getting higher rents. That's the sweet spot.
Which naturally flows into NOI growth.
You got it. Domestic net operating income, NOI, was up 5.1%. Portfolio-wide NOI, slightly better, up 5.2%. It's simple math, really. More tenants paying higher rent equals higher operating income. They're executing.
I thought the leasing details are really interesting, too. Over 1,000 leases signed.
Yeah, huge volume. Over 1,000 leases covering about 4 million square feet just in the quarter. But here's the kicker.
What's that?
Roughly 30% of that leasing activity, it was new deals, not just renewals keeping existing tenants. That shows retailers are actively seeking out these specific locations. They need to be there.
That's a really strong indicator of demand.
Yeah.
Now, what of the consumer? Did management give any color there? We keep hearing about pressures.
They did. They described it pretty directly as a K-shape situation.
The K-shape again, meaning the rich are spending and others not so much.
Basically, yeah. They saw much better results in their centers that cater to higher income shoppers. Florida was specifically mentioned as being very strong. Seems like that high-end consumer is, still spending.
And the other side of the K.
The value-oriented centers were described as flat to eating along. So holding steady maybe, but not growing, definitely seeing the impact of inflation or caution on that end. They also flagged one specific area, Las Vegas properties, showing slightly down comp sales, attributed it to weaker tourist traffic than expected.
That K-shaped dynamic, that split, it actually leads us right into the strategic moves, doesn't it? Because SPG seems to be really focusing on consolidating those top-tier assets. Let's talk Taubman Realty Group, TRG.
Yeah, this was the big strategic news. They closed the deal to buy the remaining 12% of TRG they didn't already own, paid for it by issuing about 5 million LP units. So now SPG has 100% control over that portfolio of really high-end luxury malls.
And the valuation, they gave some details on that, right?
Yeah.
Because buying assets right now isn't cheap.
They did. Management said the whole TRG deal, including what they bought earlier, pencils out to an implied cap rate of 7.25%, which, in today's rate environment, that's pretty decent.
Decent, but they think they can do better.
That's the plan. The target is to get that yield over 8%. They believe they can squeeze out another 50 basis points, 0.5%, just through operational efficiencies now that they fully control it.
Okay, 50 basis points.
Mhm.
How is that just like financial engineering?
No. It's boots on the ground stuff. It's integrating TRG onto SPG's platform. Think standardizing maintenance contracts, using their bigger leasing team across all properties, maybe redeveloping certain spaces faster. It's about leveraging SPG's scale and operational expertise. They expect to see the full benefit, the full accretion by 2027.
So basically bolting on these high quality assets and running them the SPG way to get more value.
Exactly. And that ability to find these deals and then actually improve the operations, that's a huge advantage.
We should probably mention the accounting quirk here too, because they consolidated the rest of TRG.
Right. There's going to be a large non-cash gain hitting the books in Q4. It's not FFO, it's a GAAP thing because they have to remeasure the equity they already held up to fair value.
So important for investors to just be aware of that. It'll make the GAAP numbers look a bit noisy in Q4, but the key metric is still FFO.
Precisely. Filter out that non-cash gain, focus on the core FFO performance. Okay, so that's TRG. But they're also investing in new developments, right?
They are. The current pipeline, SPG's share, is about $1.25 billion. And they're projecting a blended yield of around 9% on that. What's interesting is almost half, 45%, is mixed-use projects.
Mixed use, so not just retail.
Right. This plays into that whole placemaking idea, turning malls into broader destinations. They announced a huge new project, Sagefield, down in South Nashville, 100 acres.
Yeah.
Luxury mixed use, boutique retail, sure, but also dining, wellness centers, even a luxury hotel.
So it's about creating an experience you can't just replicate online.
Exactly. And part of that is also bringing in different kinds of tenants. They mentioned working with non-traditional retailers like Netflix, apparently opening a flagship store soon, but also Google, Net-a-Porter. It's diversifying beyond just apparel.
Makes sense. Keeps things fresh. What about the balance sheet side? Funding all this.
They tapped the debt markets, did a $1.5 billion senior notes deal, got a weighted average coupon of 4.775%. So still accessing capital at pretty reasonable rates, all things considered. Liquidity looks very strong, around $9.5 billion.
And capital allocation priorities, with the dividend now above pre-COVID levels.
Yeah, this is a key shift. Management explicitly said that with the dividend restored, the top priority now is share repurchases. They want to effectively buy back the equivalent number of shares or units that they issued for the TRG deal.
Interesting. So they're essentially saying, we think our stock is undervalued compared to the assets we just bought with those units.
That's the clear signal, yes.
Yeah.
Okay, let's connect this back to the wider world. Any comments on macro stuff like tariffs?
They remain cautious there, said the full impact probably isn't being felt yet, and if it does hit, it'll likely hurt the smaller retailers more, the ones with less inventory flexibility and buying power.
Right, but maybe the most interesting part of the whole discussion, for me anyway, was around technology and the future of retail. Someone asked about AI, like ChatGPT agents disrupting things.
Yeah, that was fascinating. The CEO's take was surprisingly bullish on physical retail, almost contrarian.
What was the argument?
The core idea was, if AI makes us all much more productive, boosts GDP, maybe leads to something like a 3-day work week, well, people will have more money and more free time. And where will they go?
Go to the mall.
To holistic environments, yeah. Places with shopping, dining, entertainment. The argument is people will crave those real-world experiences even more.
That's a bold take. He seemed pretty confident in the longevity of malls, too.
Extremely. He emphasized the 70-year longevity of these high-quality mall assets, and then he contrasted that directly with newer asset classes, specifically calling out data centers. Said their 5-year outlook is uncertain because technology changes so fast.
Wow, throwing shade at data centers.
Yeah.
That's quite a statement. Is that a fair comparison, though? Data centers seem pretty essential right now.
Well, the counter is obviously obsolescence risk for malls, too. But his point, I think, was about the nature of the asset. A prime mall location secured decades ago is, in many ways, irreplaceable land and infrastructure. You can renovate it, like with Sagefield, adapt it. Data centers, his argument goes, face much faster technological obsolescence cycles. Today's cooling system is tomorrow's antique. It requires constant, massive reinvestment just to stay current.
So he's betting on the enduring value of physical place over the churn of technology infrastructure.
Seems like it. And that view really frames all the capital decisions we just talked about, buying all of TRG, prioritizing buybacks. It's a big bet on the long-term durability of these specific physical assets. And they feel generally positive about NOI growth continuing into 2026.
Okay, perfect setup for our next segment then. Let's shift gears to our not financial advice segment. Time for an outrageous but plausible trade idea based on this call.
All right. The premise here feels pretty straightforward, building on everything we've discussed. SBG has consolidated these top-tier TRG assets. They've shown they can execute operationally, and they're aiming for that 8% plus yield on the deal internally.
Which is a return. The broader REIT index, like the XLRE or weaker mall peers, just can't really offer from internal operations right now, especially with rates where they are.
Exactly. So the trade idea, it's a paired trade. You're betting on that quality gap widening. Go long SPG stock, betting on those TRG synergies and the value creation from projects like Sagefield. And simultaneously, go short a basket of weaker regional mall REITs, or maybe just short the general retail REIT ETF, the XLRE.
So you're isolating SPG's execution against the general market sentiment.
Pretty much. You're leveraging management's own confidence, that 70-year longevity argument, that 50 basis points they expect to squeeze from TRG ops. You're betting they can deliver that internal value regardless of the macro noise hitting the rest of the sector.
And the market, maybe, hasn't fully priced in how accretive buying TRG at that effective cap rate could be in this environment.
That's the thesis. It's a best-in-class consolidation story versus generic sector fear, trading SPG's execution against the macro tape.
All right. Outrageous but plausible indeed. So let's quickly recap the main takeaways from this deep dive on SPG's Q3.
We saw that significant FFO beat definitely beat expectations. Strong guidance raise for the full year. And strategically, the huge move was full consolidating Taubman Realty Group, TRG, at what looks like a very attractive cap rate, especially if they hit those synergy targets.
Well, management really planted a flag on asset longevity, didn't they? Making that bold comparison between 70-year-old malls and potentially shorter-lived tech infrastructure like data centers.
Yeah, that was memorable. He drew a real line in the sand there.
Which leaves you, the listener, with a final thought to chew on. If this CEO running the biggest mall company in the world is right, if proven, 70-year-old physical infrastructure can actually be a more durable, adaptable investment than brand new tech infrastructure. Well, how do you actually value that kind of longevity? How do you factor in irreplaceable physical presence in a market that's always chasing the next big digital thing? Something to think about for your own research.
Definitely something to consider. Well, that wraps up this deep dive. As always, we encourage you to keep exploring these themes and what this call means for the sector.
Thanks for joining us on the deep dive. We'll catch you next time for another synthesis of critical market intelligence.